we have Professor and Dr. Jennifer Walsky, who's the adjunct assistant professor at UCLA Anderson and serves as the interim faculty director of Impact at Anderson. As a writer, researcher, and investor, Dr. Walsky sits on numerous for-profit and nonprofit boards. Her research centers on the funding and scaling of startups, with an emphasis on social startups and social venture capital firms. Dr. Walsky has received numerous research and teaching awards, including the Best Paper Award from NYU Stern's Social Entrepreneurship Conference and the Chait Award for Teaching Excellence at Berkeley Haas. Prior to her academic career, Dr. Walsky was an institutional All-American ranked investment banking securities analyst and a regular commentator on both CNN and CNBC. Prior to investment banking, Dr. Walsky served in product marketing roles at Synopsys and Intergraph. She holds a doctorate in strategy and entrepreneurship from Boston University and an MBA from Santa Clara University and a BA in communication studies from UC Santa Barbara. We also have the honor of having Brian Trelstad, our guest speaker here today, who is one of the pioneers in the field of impact investing. Brian is a partner at Bridges in the U.S. Sustainable Growth Fund, a director of the Bridges Impact Foundation in the U.S., and a leader of impact advisory activities. Brian has nearly 20 years of impact investing experience, having written the business plan for Acumen in 2000 and having served until 2012 as the chief investment officer, where he oversaw $55 million of investments into companies that were delivering health, water, energy, and agricultural services to the economic base of the pyramid in South Asia and sub-Saharan Africa. As CIO, he was a member of Acumen's management team and helped build out the network of country operations that work closely with the entrepreneurs. Brian was also a co-founding board member of the Aspen Network of Development Entrepreneurs, ANDE, and was one of the principal architects of impact management software tool, Pulse, and the impact reporting and investment standards known colloquially as IRIS. Prior to Acumen Fund, Brian worked as a healthcare consultant at McKinsey & Company and was a lead environmental staff person at the Corporation for National Service and has been involved in starting and advising a range of nonprofit and for-profit startups. So Brian has an undergraduate degree from Harvard, an MBA from GSB up at Stanford, and an MA in City and Regional Planning from Cal as well. He also teaches social entrepreneurship at Harvard Business School. Brian was the first impact investor to go through the Kauffman Fellows Program of the Center for Venture Education and is a Henry Crown Fellow of the Aspen Institute. Also of note, Brian founded Mint, the MBA Investing Network and Training, which is the premier case competition for impact investing for MBAs, and in many ways, an organizing body for the next generation of impact investors out of business school. UCLA's team was a finalist at Mint last year, and we hope to take the next step as we'll send a team to Mint in just a few weeks in April. And with that, and without further ado, I'll kick it over to Professor Walsky and to Brian to get started.
So Brian, it's nice to have you here at UCLA. So we worked together on a case on bridges, and it's sort of interesting because a lot of the case centers on the political economy, and clearly we have Super Tuesday happening tomorrow here in the United States, but we've seen some interesting effects with sort of the elections that have happened, both Brexit as well as what has happened in the US with the move towards popularism. We're going to talk about that a little bit later, but when you take a look at the theme or the investment thesis around bridges, a lot of it is on addressing some deep societal issues with a capital infusion and also a partnering with the government, which is how it originally started. So I know you weren't at Bridges at the time, but take us back to 2002 when Bridges was first funded in the UK, and sort of what was the catalyst for that?
First, it's great to be here. The last time I was at Anderson was in the fall of 1998 when Anderson hosted the Net Impact Conference. And so it's good to be back. The campus has changed a little bit in the last 22 years, if my math is correct. But back to only a few years after that, right? So I was a business school student. I graduated in the class of '99. There were no classes on impact investing. It wasn't a term There was one class on social entrepreneurship. We were fortunate at Stanford to have a guy named Greg Dees, who we had stolen from Harvard, who I got the chance to take a course with. There was no class on sustainable business. So these topics were very much resonant in many of the students who were joining Students for Responsible Business, SRB, which became Net Impact. But it was not something that had a term. And fast forward really only a couple years later, and in 2000, the founding chair of Bridges, a guy named Sir Ronald Cohen, who had gone to Harvard Business School on a fellowship, and the commitment that he had to the fellowship from the UK government was to pick one American business practice and bring it back to the UK. And the one business practice he was excited to bring back to the UK was venture capital. So Ronald was credited as one of the first venture capitalists in Europe and helped build a global private equity firm called Apax Partners. In 2000, he had moved into a role as chair of Apax and was not very active in the day-to-day investing, so was involved in a range of philanthropic and policy activities when he was asked by Prime Minister Tony Blair at the time to head up a social investment task force. There was a concern in the late 90s after the kind of first dot-com bubble burst in 99-2000 that there was a growing divide between rich and poor in the UK, with London doing phenomenally well and the rest of the country not doing so well. This is 16 years before Brexit happened, and I think the UK government at the time recognized that the root of that problem remained unaddressed. And so the UK government asked Ronald and one of my founding partners at Bridges, a woman named Michelle Giddens, who had worked at a CDFI, a global CDFI called Shorebank, to head up a task force on social investment, to look at whether there were ways to address this gap using kind of market capital. And so they put out a report, like all reports, they, 5 or 6 recommendations. Ronald, as a person of action, decided he didn't want the report to sit on a shelf and collect dust like many government task force reports do. And so recommendation number 4 was there should be a community development venture capital fund. Ronald and Michelle had actually come to the US. There's a long tradition of community development venture capital here in the US. Many regional funds, the Maine Coastal Ventures Fund or the Rural Appalachia Fund had always remained relatively small and subscale. And what Ronald thought would be helpful for the UK at the time was to launch a community development fund of sufficient scale to attract the kind of talent that Apax attracted, but to have the same kind of commitment to impact that American CDVCs did. So we launched, I say we again, I wasn't there at the time, but Bridges was launched in 2002 with a commitment from the UK government of $30 million and private capital from investors and folks like Ronald who just believed that this was a good idea to solve the problem at the time of $30 million, and the rest is history.
And it's kind of interesting because you look at what Ronnie Cohen did, and he also did social finance and social impact bonds at the same time. And our mutual friend Tracy Palangian that's now carried to the U.S. markets as well. But really looking at sort of this intersection of privatization or catalytic capital is probably a good way to put it, to sort of cement and make more efficient some of the services that were needed or solutions that were needed for societal problems. So let's talk a little bit about a couple of examples of investments that Bridges based in the UK did. So there was Babington, which did some workforce training. And one of the things that was interesting to me in researching this case is it was historically they use a different term in the UK, it's called depraved, but that's basically low income. And it was traditionally pensioners who were in that category. But they started seeing for the first time some of the fact that there was this mishmash of skill sets versus the jobs that are available, coal mining and other industries, we could say in the US seeding of manufacturing. And you started seeing people in the sweet spot of 20 to 40 that were now the bulk of the unemployed, like 40%. This is a huge problem, short term, and then if you dial forward many years, long term, right? US started having the same issue, and that's why we're talking about opioid epidemic and a lot of other things. Same issue with the seeding of manufacturing, that suddenly we were having people who should be at the prime of their work life that were not employed because of mismatch of these skill sets. But Babington's sort of interesting because that's something in a private equity way that Bridges in the UK invested in, and that was supposed to bring some business type solutions to that population, sort of a retraining move, right? Can you tell us a little bit about that?
Yeah, so the the company Babington was essentially a vocational training school, and as Bridges evolved from its first fund to later funds, the first fund did some venture capital, did some turnarounds, but did some essentially buyouts of small businesses. The buyout strategy became the dominant strategy, where we found that we made the most money. And what we discovered in the education space, particularly in the UK, it's a much different market, there was a category of very fragmented and often very ineffective vocational training businesses. And Babington happened to be one of the better ones. And it worked, had high placement rates, had high student satisfaction rates. And so the question was, what were they doing, and could a roll-up acquire Babington as a platform and then go buy a bunch of these other subscale and use that as a way to disseminate Babington's better curriculum, its better outcomes, its better teachers, its better culture. And so Babington, which relies, again, it's a business model like many of the investments we make in the US that relies almost entirely on the government for revenue, because the government was paying for these retraining programs, but the government at the time didn't have a real focus on outcomes. And so what Bridges did was bought Babington, bought a number of smaller vocational training businesses, and was able to kind of raise the performance and raise the placement rate. And so that's an example of taking a small business in a fragmented market where improved performance, both on the impact perspective and the commercial perspective, can be reinforcing.
So let's look at two of the quick examples. One is the gym. And this is an area where, for those of you not familiar, private equity differs from venture capital in that it's not a syndicate of investors investing in a company and then sort of a little bit hands-off. Private equity, you often step in, you put in your own management teams, and you really sort of take over the enterprise, make it better, and then look at an acquisition or growth strategy for that. So let's talk about the gym, because that's sort of an interesting twist on this whole model, because that's one that you sort of incubated internally at Bridges in the UK.
Yeah. So health and wellness became an area that we were focused on, and again, we spent a lot of time looking at broad secular trends, and the UK had the same kind of trends toward obesity, diabetes, chronic poor health that also was correlated with income levels. And so if our motivating thesis was, what are some of the businesses that can help folks living in low to moderate income communities? Health and fitness is one of them. It turns out that the UK had the most expensive private gym market in the mid-2000s. And so the question was, okay, well, if obesity and diabetes are problems, what is a private sector solution to that? Fitness and recreation, weather's not as nice in the UK most of the time as it is here. So how could you find a way to create an affordable gym chain? And so actually our managing partner, Phil Newborough, spent some time looking at Planet Fitness, spent some time looking at a couple of gym chains in Germany, and we essentially built a business model that reverse engineered how do you strip out the costs and enable a gym to operate on 16 to 20 pounds per month per member. And we were able to do that, and we put about £1 million into a sort of a first startup gym. We sort of perfected the model, got the assumptions right, and then we were able to roll it out and became probably our best investment in the UK, returned most of Fund 2, and has really allowed us to continue to invest in affordable gym chains in Spain and Portugal as well.
Okay, third example is the old vinyl factory. So this is kind of cool. That was originally where Apple Records, the Beatles existed, and then it sort of became a lower income neighborhood, and Bridges stepped in and was part of a revitalization effort there. Can you expand on that a little bit for us as well? I think these are good examples to give us how does this work, and what is the model actually enacted?
Yeah, so Bridges started doing private investing in companies, again, venture capital and private equity, moving towards mostly private equity. A number of our early investments had a very strong real estate component. The gym, we did a serviced office business that is a precursor to a WeWork. We called it The Office. We have creative branding, the gym, the office, the vet. And so we were approached because of the success. We also did a hotel, not called the Hotel, but called the Hoxton, which if anyone's been to London, the Hoxton Hotel is a very kind of hip, chic, affordable hotel on Old Shoreditch High Street. So we had an eye towards, the investment team had an eye towards real estate investing. And so a number of our investors at the time in 2007 or 8 came to us and said, could you do a real estate fund in addition to business fund? And so our largest and most successful strategy really in the UK has been property funds. And we do kind of economic redevelopment, LEED certified buildings using the GRESB standard in the UK. And so we've built up a pretty strong expertise in how do you use kind of a lens on impact to make real estate investments, property investments. And the old vinyl factory, as Jennifer said, was a derelict old manufacturing facility that was right on top of where the new Crossrail link is going in a significant transportation infrastructure. And so as we think about ways to create more affordable transit-oriented housing in London or in American cities, the old vinyl factory was a perfect example of creating, converting an iconic building into mixed-use, mixed-income housing, and is representative of the kind of investments we've been successful with in the real estate strategy.
So we're sort of setting the table here for 2002, what happened over the 10 years, sort of the credibility. I mean, Bridges now raised $1 billion in capital, 12 funds. So you're sort of getting this trajectory, right, of probably a win-win for the government. In fact, when Theresa May was originally elected, the first thing she did is said, we want to invest in our own domestic policies. And so this is kind of a win-win for everyone, including politicians. Fast forward to 2012, when you and I have known each other for a while. I remember when you're looking at kicking off a U.S. domestic fund after being Chief Investment Officer at Acumen Fund for some time. What was it like to kind of partner with Bridges on a U.S. strategy? And again, what was the catalyst for a U.S.-based fund?
Yeah. Well, there were two catalysts. One was I had left Acumen Fund. I loved working there, but felt sort of compelled to invest closer to home. It was also a little bit tiring to take the 14-hour flights to board meetings in Mumbai and then have to turn around and realize that my job to be done well at Acumen Fund needed to sit in Nairobi or Dubai or Mumbai. And so I ended up approaching Jacqueline Novogratz, the founder of Acumen, and saying we should find a chief investment officer who wants to live in one of the country offices. And we ultimately were able to do that, found somebody who split his time between Mumbai and New York. I then decided I would want to go raise a fund. Initially thought about maybe it could be Acumen America, but I saw a gap in the marketplace where there wasn't really an impact investor who was sort of deeply impactful, but also focused on slightly more mature businesses. A lot of impact capital in the United States is really still at the venture stage, and so there wasn't anyone who was a little bit later stage. And so was beginning to put this strategy together and had a conversation with one of my mentors, somebody who'd been on the investment committee at Acumen Fund, a guy named David Blood, who'd started Generation Investment Management, which is a large public equities, impact or sustainable investment fund.
With Al Gore, by the way, just
That's
a few
right.
other name-dropping things here. Yeah.
And so I presented to David, and he said, look, I'm happy to invest. You should know that Bridges, where he had been, he's based in London, he'd been an investor since Fund 1, had been thinking about coming to the US. So switching hats, Bridges at year 10 was quite proud of what it had accomplished. I think by the time it was about $250 or $300 million, they had growth equity, they had real estate funds, we had the first social impact bond fund in the world, and so there was this sense of, wow, promise and optimism, and impact investing was now at this term, and there was more capital flowing into the space, and there was a desire to go see if Bridges could spread beyond the UK. And there was a debate internally between emerging markets strategy, likely focused on sub-Saharan Africa, and the US. And the advisory board at Bridges had this conversation, and Ronald, I wasn't in the room, but is reported to have said that if Bridges wants to be the most influential impact investor in the developed world, it needs to be in the largest developed market, which is the United States. And so that sort of ended the debate about emerging markets versus US. And so they began to look for a team in the US at the same time that I reached out to them through David Blood's introduction. And so we compared notes, realized that my thesis and their thesis were very similar, and we joined forces at the end of 2012.
So what were the challenges in this? Because you do have this very successful name, brand, and recognition, this UK company. I would say internationally starting to be known as this emerging impact investing space. But then you come into the US markets and population and GDP 6 times larger than the UK, huge geographic distances. And so how did you sort of crack that nut? And how did you look at who the investors or limited partners would be in a fund like that to look at how your both investment thesis and fundraising strategy would come together? Yeah,
so Bridges had a phenomenal brand name and reputation in the UK. They also had a phenomenal brand name and reputation among the impact investing cognoscenti, who circa 2012 could probably all fit in this room. And so it was the usual suspects. It was the members of the GIN. It was the Prudentials and the Herons of the world, the MacArthur Foundations and the Hewletts and the Packards, and not even the Emerson collectives or the Chan Zuckerberg initiatives, because those didn't exist. I'm not even sure Facebook existed at the time. Actually, it probably did. But it was still a very nascent idea, impact investing, particularly among the large asset allocators that were a part of the attraction for bridges to enter the U.S. market. And so I think we overestimated the brand value, and particularly to the small entrepreneur in Cincinnati, Ohio, who's looking to raise capital and sell his business, has never heard of bridges, and looks at the website and sees that it's mostly in the UK, so wonders whether we're in from London for the week. And so it ended up becoming a challenge to try and establish the Bridges brand and reputation beyond just the impact investing diehards, and use it as a way to convince kind of people who to this day are still skeptical that impact investing does not require a financial trade-off, that Bridges knew what it was doing, and the Bridges US strategy could be both faithful to the Bridges success, but also aware of and adapt to the US market context.
So some of the initial big investors were the Prudentials, the Morgan Stanley, the Heron Foundation, you mentioned them earlier, but in particular there's community development funds, right, that some of the banks could use and allocate towards this.
Yep.
There's some discussion of program-related investments or mission-related investments. Sort of, how did that sort of net out in your fundraising strategy?
Yeah, so we had the banks, large US banks are regulated and have to comply with something called the Community Reinvestment Act, which is penance for their sins for not having loaned to African American communities in the redlining practices of the 50s and 60s. So banks now have to invest a certain portion of their assets where they hold them in low to moderate income communities, and each of them has a large Community Reinvestment Act team. Many of them satisfy that obligation by investing in affordable housing, buying mortgage syndicates or pools of mortgages to low-income housing, but many of them have fund-of-fund strategies where they invest in impact investment funds. And I would say that the growth of impact investment over the last decade really does stem from the banks' more creative use of Community Reinvestment Act capital, and recognizing that this is money they have to invest, and many of them are willing to trade financial return just to have a satisfactory rating. There's really no incentive other than to not be on the Treasury or the Office of the Comptroller of the Currency's bad list. If you don't have a satisfactory rating, you can perhaps not merge if you decide that Wells Fargo wants to buy Bank of America and Wells Fargo's CRA rating is bad. The U.S. government will hold that up. And they've done that in the past. So banks it's like this third rail, so they have to go invest. The one that was the most progressive for us was Morgan Stanley. And what was happening within Morgan Stanley was they were saying, okay, we've been doing a lot of impact investing, there's lots of interesting things that are happening, but over on our private wealth side, we're starting to recognize that more and more of our clients are asking for this kind of stuff. And it's whether it's a generational shift or whether it's a gender shift. There were more conversations within Morgan Stanley about ESG and impact investing, and when Morgan Stanley turned around and looked at where it could allocate capital, there just weren't enough managers that could absorb a 25 or a 50 or $100 million check. And so Morgan Stanley's intention was to use its CRA capital to seed a bunch of managers who would be able to, over time, on a second or third fund, absorb a $25 million commitment from the private wealth. And what I've learned in the fundraising for private funds, there are a lot of people who can write a $250,000 check or smaller, and there are a lot of people who can write a $25 million check or larger, but there are not a lot of people in between. And so impact investing to date has still largely raised capital from a combination of the $250,000 check writers, the small high net worth individuals who are allocating a piece of a $5 or $10 million kind of retirement plan, but very few have tapped into the CalPERS, the CalSTRS, the Texas Teachers, the sovereign wealth funds, and it's those CRA banks, the insurance companies that have the discretion to write $1 to $10 million checks, who've really built the field. And I think the test will be whether or not those of us who've been in the business for the last 10 years will ultimately be able to present to the $4 trillion at BlackRock and make a compelling case for why they should write a $50 million check into our second or third fund.
So I have one more question, and then I'm going to open it up to the audience. So I just want to make sure you guys are prepared to think of the question that you might want to ask in our time. Let's dial back to kind of the setting of where the case is, which was right after President Trump was elected, and Brexit is happening. And so we talked about in the social investing space, sort of this intersection of government agency involvement, societal issues, private capital. You all looked at this and trying to kind of ascertain this move towards nationalism or popularism, depending on how you coin the term, and what are the investments thesis that make sense. I know initially you looked at a real estate investment. I know initially you also looked at after-school childcare. Both of those played into Ivanka Trump's childcare working mothers program. Real estate obviously plays into President Trump's experience for a variety of reasons. But let's talk about one of your more recent investments, which is Sunrise. And tell us a little bit about Sunrise and what the investment thesis is around that.
Yeah. So right now, Bridges in the U.S., we invest in education, healthcare, and environmental services businesses. We're not very technology focused. We're looking to invest in companies that have somewhere between 10 and 20 million in revenue and 1 to 3 million in EBITDA. And often we're looking to invest in a founder who, I sort of like to think of them as almost accidental entrepreneurs. They were a clinician, they start a clinic, or they're a behavioral psychologist, and they start working with kids with autism, and lo and behold, 10 years later, they've got a business that's got 15 million in revenue and 75 employees, and what they really want to do is bring on professional help, maybe cash out, because this has become their largest personal asset, the business that they own. And so in each of those domains, we have a number of areas where we think, gosh, there's a compelling social need. There are business models that we know that are successful and growing, and one of those, obviously, and sadly, is substance abuse, prevention and treatment. And so we had gone through 30 or 40 businesses in the opioid substance abuse space. We had kind of ruled out methadone clinics because we weren't really sure that kind of method of treatment was the right one in terms of an effectiveness. So we were looking at businesses that treat using buprenorphine. We also liked businesses where you actually got the medicine on site, and so on-site dispensing versus medically assisted treatment where you had to go then to a pharmacy had greater efficacy. We also liked the combination of medically assisted treatment with counseling. And so once you kind of run through that filter, there aren't that many who do that. And we met through a competitive process. And again, unlike venture, where most of the companies raise the money themselves, small businesses, much like homeowners, use brokers. And those who don't are for sale by owner, and they often don't get the best bid. But those who work with a Coldwell banker, it's a process. And so we had met a company in Cincinnati, Ohio, through a broker. They put the for sale sign on the business, and had been working with another private equity buyer. We were in that process, but we were not the highest bidder. But ultimately, the private equity buyer that had signed terms backed away from the deal. They didn't ultimately think it was worth what they said it was worth, which is what we thought it was worth in the process. And so the business didn't sell. And so it was about a year later, after all of the kind of non-competes and NDAs had worn off, we noticed that they had won a Cincinnati award, and so we wrote an email to the founder and said, hey, congrats on this, and what are you up to? And lo and behold, he was still interested in selling, had really liked getting to know us. And in a competitive process, and we talk about this question of, is it impact if we invest when somebody else could have invested? What we've discovered is that a lot of these founder owners really like the mission-driven nature of our investment, the fact that we ask about effectiveness and outcomes as much as we ask about EBITDA and margins. And so he liked us in the process. We were actually his preferred partner, but we didn't have the winning bid. And so he was willing to re-engage with us without a broker because he liked who we were, and we ended up buying this company. It had about $25 million in revenue now. It's growing at about 25% per year. Fortunately, the growth in overdoses and substance abuse has stabilized in southwestern Ohio where they are, but the number of people who are still struggling with managing their disease is still pretty constant. And they're a very small part. They and all the other providers in the state still only cover a very small percentage of the people who are managing their addiction. 99% of the customers are reimbursed through Ohio Medicaid. So it's a very low-income population, a very unstable population. But the persistence of folks at Sunrise, most people stay in treatment for at least 6 months. Most of them manage to stay off of opioids during their treatment. And so we were pretty comforted when we went in that it checked the bar on both impact as well as commercial diligence.
Have you had a chance to see post-treatment what the recurrence rate is? Or
that's one of those questions which we'd love to see. They don't have visibility to their clients after they're done. And so we actually, at our last board meeting, we talked about were there ways that we could ask people how they were doing after release and treatment.
And there's a lot of HIPAA laws. We have an investment in a company here based in Santa Monica called We Recover that also is looking at kind of this bed matching scenario and how to address that. So with that, I have other questions. I have no shortage of questions. We talked actually extensively earlier today, but I would like to open it up to the floor. So are there questions from the floor?
You mentioned the idea of a larger capital base coming in and being able to write a different class of checks.
Yep.
And obviously allocating $25 million is very different than allocating $250 million, which is very different than allocating $2 billion.
Yep.
And the scope of companies you're looking at. Do you feel comfortable with the ability to scale if you were able to raise, 2 or 5 or 10x the capital and what that would look like?
And you're getting ready to raise your second fund pretty soon, right?
Yeah. It's a great question, and the capital needs to fit the opportunity you're pursuing, and for us, we think, and we have a $65 million fund. You're not allowed to write a check that's greater than 15%, which caps us at about a $10 million check, without going back to all our investors and saying, hey, we'd like to go over this concentration limit. We think we could easily be in the kind of $15 to $20 million check, looking at businesses with, say, 25 to 50 million in revenue and $3 to $10 million in EBITDA. And that actually would probably be an optimal place to play, because the kind of $1 to $3 million, a $1 million EBITDA company is kind of a bad quarter or a coronavirus from actually, having, real cash flow problems. And so having a little bit more stability, a little bit stronger of a management team would still put us well below where most of the large buyout firms operate. And we think we could do it. If somebody were to hand me $1 billion tomorrow, I'd hand it back, because it wouldn't be, for us, it wouldn't be a good use of our team's time and talent to try and invest that well. But somewhere between 150 and $300 million, I think we could do that really well.
And even since you guys launched, some things have happened, right? We were talking about earlier today that you've got the Rise Fund coming out of TPG, you've got Bain Capital jumping in. In fact, you did a co-investment with Bain Capital. Can you tell us a little bit about what that was like?
Yeah, so, and I mean, again, as you see, Bain, TPG, KKR, Apollo, they are satisfying the need for the large asset owners and asset advisors to allocate large checks into $1.5 billion funds, because again, a Bridges or an SJF or a Impact America or any number of the core innovation here in LA just can't absorb a $25 million check. So you're seeing the large private equity firms create new sleeves in this space, in part because they see an opportunity, and in part because they're solving the problem for some of their existing LPs. Bain, we got to know early on, Governor Patrick, within about a month of his having left.
Former presidential candidate.
Former president, well, suspended.
So there's
suspended.
a long.
So Deval Patrick, former governor of Massachusetts, left office, and within a month he had been in touch with Ronald Cohen, who put him in touch with the guy in the U.S. who happened to be me. And so I met with Governor Patrick as he was thinking about impact investing before he joined Bain. We got to know one another and his team as they started to make investments. And one of them was a Planet Fitness franchise. And we had gotten sort of pushback from LPs like, well, we don't think the gym is an impact investment. We have Planet Fitness. We're like, oh, we would never do a gym in the U.S. The market is sort of, that problem has been solved. And the thesis for why we did what we did with the gym in the UK that problem didn't exist in the US. So lo and behold, we get a call from Bain in the fall of 2016, and they say, we've got a Planet Fitness franchise, under letter of intent. We'd really like to know how you guys think about the impact of gyms. And we had thought a lot about it. And so I said, well, we'd be happy to tell you everything we know if we could co-invest. And so it was about a $30 million equity check. It was a much bigger investment than we could have made, but it was a chance for us to split that and work with Bain. And I think it was an interesting test because private equity is a fiercely competitive business, and unlike venture capital where people syndicate deals because there's shared expertise or just because many venture capital funds are so small that they want to bring in other folks to write more checks. In private equity, that does not happen as much. And so for Bain, it was a chance for them to kind of play in the sandbox in a collaborative way. And we were able to, at a Planet Fitness franchisee in Michigan and Indiana, really try to understand how they marketed to first-time gym users. Planet Fitness franchise is all about a no-judgment zone. Anyone been a member of a Planet Fitness? The median member of our Planet Fitness was a 53-year-old woman who'd never belonged to a gym before, who was, we didn't do, any physical screenings because that was a judgment, but we knew the diabetes rates we actually looked at each of the gyms and we looked at the diabetes rates in the counties around each of the gyms, and it was above the national average. It was above the state average. So these are mostly low to moderate income communities that were struggling with the same kind of challenges that we were tackling with the gym. And so we then went in and said, okay, well, how do we help lengthen the membership? The average membership was like 8 months. How do we make sure that the usage goes from once or twice a month to 3 to 4 times a month? And how do we experiment with partnerships with insurance companies or Silver Sneakers, which were trying to incent their members to join gyms and use gyms? Because there actually is not a huge amount of evidence that joining a gym leads to better health outcomes. There is evidence that exercising leads to better health outcomes. So then the question is, how do you make sure that there's a link between joining a gym and exercising? And that was the question that, frankly, is one of the kind of impact risks of gyms, because they do make a lot of money on what are called sleeper members. Has anyone ever joined a gym and not gone for several months in a row and say, yeah, so, and then, it's not that easy. I just canceled Boston Sports Club in Boston because I hadn't been there for 4 months.
I've been trying to cancel Equinox for 6 months, and
Yeah.
for this, he keep losing my cancellation form. I
Yeah.
can't quite understand what's going on.
I think
like 3 times.
I think the answer is you should call your credit card and say it's a fraudulent charge.
Yeah,
and
exactly.
See what happens. Anyway, so we really wanted to try and understand how do you build this, and we owned 15 to 20 gyms. The management team was super aligned. We got them to take the B Lab assessment. They scored terribly initially, but then because they were kind of competitive gym guys, they wanted to get a high enough score to be B Lab or B Corp eligible. And the conversations we were having about answering these questions were ones that actually began to filter into the Planet Fitness headquarters. So 1,500 gyms in the United States. So whatever we were testing became a bit of a lab for all of the gyms, and we felt like that was the kind of impact that was worth our $5 million investment.
The coronavirus has been causing a lot of tanking in the stock market and just global economies in general. I'm curious to see what your take is on it in the impact investing space, because if valuations, for example, are tanking, is that like a prime opportunity to act and get deals at a lower valuation, or does it fundamentally make it harder to run businesses and just grow them because of cash flow issues and other issues you mentioned?
And we should talk about maybe general exogenous shocks. I mean, Bridges has had to go through the mortgage crisis in 2008. Private equity has a long tail as opposed to the stock market. So how do you kind of manage through these things?
Yeah, well, I mean, the greatest exogenous shock has been, Brexit for the UK, because the UK to some extent entered the US market thinking that there would be all sorts of US investors who wanted to invest in the UK, and that has not come to pass, and Brexit has made that harder. As we think about coronavirus, I mean, it might be just a catalyst for what many people see as a needed market correction, because the valuations in private equity have just gotten crazier and crazier. So the returns over the last decade, do remind me a little bit of the kind of greater fool theory of, 98, 99 in the first dot-com bubble. I don't know I don't think anyone knows how this is going to translate into business operations. I do think it raises, everyone's sensitivity towards the fact that their best laid plans can be derailed, and you have to have, smaller bets and manage them all carefully and be thoughtful of what happens if something comes along. So we've actually just in the last 24, 48 hours done a little bit of a fire drill with each of our management teams on what, how they're prepared for it and what effects it might have. I don't know whether it's going to, fundamentally reshape private equity in the near term. It's just too early to tell.
Hi, Brian. I'm Beverly. I'm an EMBA alumni. I just graduated last year. My question is around performance versus purpose. So can you comment on whether you've seen tension between a fund performance and being able to make sure that you're still satisfying the purpose of the fund? Like, is it harder to find investee companies that would meet the performance that you're aiming for? And then secondly, with that, do you think there will be a trend to monitor or track not just the performance ratio, but also the impact to the community?
Yeah.
And you should talk about the four-pointed, how you
Yeah.
guys look at impact, because they have a pretty sophisticated model for impact measurement, which they apply.
Yeah, and so it's a great question, and sort of at the center of the impact investing. Does it require some sort of trade-off? Are you limiting the universe of investable opportunities? Most good investors have a clear thesis, and so most good investors ignore 95% of the investable universe to pursue that thesis. If you're a biotech investor, you do not invest in ed tech companies by definition, and so you choose, again, a market opportunity with a relevant amount of capital to execute against the thesis, and somehow people think that putting an impact filter on is going to constrain you so much. If that impact filter is unrealistic or so narrow, yes, you will be constrained. But if the impact filter is ethical entrepreneurs in the health services space, there are thousands of opportunities there. The question then is, what's the evidence that better managed businesses with commitment to measuring impact and treating employees well and treating customers well and thinking about their environmental footprint, do they outperform or not? And that's the $64,000 question in the sector. There has been a huge amount of effort that's gone into funds measuring and reporting on their impact. The challenge is, and as much as we like our radar that is written about in the case, which looks along 4 dimensions of the outcome, ESG, additionality and alignment, it's our own measure. And as somebody who's been thinking about this for a long time, it's like we've just invented our own accounting. Oh, no, don't worry about assets and liabilities. We have stuff we own and stuff we owe, and that's what we call it, and we're smarter. So use our books, but don't trust anyone else's, because our books, that's totally crazy. It's totally crazy to think that a business would be able to invent its own accounting. Full stop, and modern accounting is less than 400 years old from the Medici, and kind of in practice for maybe the last 70 years. But we treat impact reporting as if every fund manager or business should invent its own methodology, and then that methodology should be trusted. Oh, no, we don't need an auditor. Trust our books, because we have stuff we own and stuff we owe, and that's our assets and liabilities, and it's better the way we do it. And just trust the numbers we put in. So, we have a practice which is really derived from philanthropy, which is miserable at honestly reporting on the performance of the grants that it makes, because there's really no feedback loop in philanthropy. But impact investing, which kind of emerged from philanthropy, has really adopted the worst practices of how you think about performance measurement, and lets everybody define how they want to be measured. So I think unless and until there are consistent measures for how companies and funds are rated, and that information is standardized and aggregated, and then ultimately independently assessed, you're going to have people making stuff up. I think there still is room for new methodologies. I think that the TPG Rise Fund, with their partnership with Bridgespan on trying to monetize impact, is interesting, although fraught, because is healthcare better than educational achievement, and who's going to put a value on that? It can lead to some pretty slippery slope conversations. But we have to find some way to be able to compare apples to apples. Otherwise, it'll just be my story's better than your story.
We talked a little bit earlier today too about the podium problem, in the sense of you have ESG metrics, which B Labs has instrumented
Yep.
quite a bit, but then you also have this concept of additionality. And so some of the tension around that is not even just a trade-off of financial versus impact. It's also this really high bar of, oh, you have to be a unique investor and go where no man will go before, nobody else will invest in it. Oh, but it's got to be, worthwhile, and it's got to be this and that. And normally when you look at traditional investing, gosh, it's recognized that people are drawn to good opportunities, and that's a strong investment, and that's not a bad thing.
Right.
But it impacts, sometimes we put this additional, tether on ourselves, saying, oh, you have to go somewhere where nobody else is going to invest, and then you have to say, well, why is that? Maybe that's because it should be donation-based and shouldn't be an impact investment. We're expecting a return.
There are these misconceptions that are being overcome, and some of the big players are entering in, but also that you wouldn't be able to handle $1 billion check right now.
Although if you have one, I'd take it.
Okay. I don't.
You can think about it. You can figure it out. Yeah.
So at some point, if more capital comes in, will there be a human capital constraint of people who have experience making smart investments in that? So how do you see the future of the human capital side of it, and then what would you like to see to prepare people for that kind of capital infusion?
Yeah, it's a great question. That's kind of part of why we started the Mint. The observation that I had at Acumen Fund is that, an Acumen Fund really emerged out of a moment in time when venture philanthropy was on the ascent, and there was this sort of hubris that only smart business people, if only they could devote their time to social problems, all these social problems would go away. When it turns out that the lens and tools that you use to solve business problems are not always translatable into how you solve social problems. And so I think that the venture philanthropy field has backed away from that. But there was this moment early on where if you want to do impact investing well, you do have to know investing. You have to understand how to value a business, and it's buying an asset. Is it priced too high or priced too low, and how do you understand that? But you also have to understand impact. And there remains, I think, this bias towards learn the business fundamentals, and the impact stuff is easy to pick up. I actually think it's the other way around. I think people who have an understanding of how social change happens and social movements build, and how collaboration happens, and fields operate together, it's just a much harder thing to intuit than cash flow modeling, which you can take a couple classes on and learn. And it takes, as one of my mentors said, it takes $10 million to train a venture capitalist, which basically means you have to play with real money before you understand what mistakes are common, and before you can find your footing. And so, we launched the Mint in part to fill a gap at business schools, because there aren't very many Jennifer Wolskis, there aren't very many, HBS has one class on impact investing, 60 students take it, but there's still more demand and interest in the space than there is faculty capacity to teach it. And frankly, as much as I love the case method, it's not the best way to learn about impact investing, because impact investing is a process of figuring out what you care about, what problem you want to solve, finding companies that are aligned with your definition of impact, convincing an entrepreneur that you're the right partner, understanding whether their business is actually good versus bad, and then understanding how it solves both a commercial and an impact goal. And so we really created the Mint as kind of a multiplayer game by which people could experience the process of being an impact investment using a smaller pool of capital than trying to convince every school to raise their own. And a little bit, we do have funds, and I know that Anderson now has a fund, and Michigan has a fund, and at some point there may be a world in which people decide they don't want to come to the Mint finals, to which I will say, well, UCLA probably has more than 15 or 20 men and women who could play Division I basketball, but there's no scenario in the world where they just decide to scrimmage each other at Poly Pavilion and not want to compete for the national championship. And so there is something intrinsically competitive. So even if you had enough money to invest in your business, I think that students would say, gosh, I want to know whether we're better than Stanford, or better than Haas, or better than Ross, because there's this chance to showcase. And so we think, and for those who've been to the Mint finals, it's really this great sort of celebration of folks who have taken essentially an extra class outside of their full workload, and many people are in fact also working, and committed themselves to learning, and we've been able to translate that into a pretty decent on-ramp to professional opportunities. There's still far more people who want to work in the space than there are jobs, But as I tell folks, there are more opportunities than there are jobs. And so if you find a role, even in a big corporate or a traditional asset management institution, if you're familiar particularly with a scarce resource, which is understanding the language of impact, I think those opportunities will unfold.
Hi, Brian. Thank you for coming here. My name is Raghav. I'm a first-year full-time MBA student over here. My question is a bit more personal. What have been some inflection points in your career, and what do you think back and look at, what you could change, and what you could have us take away from this talk?
Great question. Okay. 2 inflection points for me. One was in 2002. I was at McKinsey. So I went to McKinsey. We were in grad school on the West Coast. My wife's family were back east, so we came back. My wife worked at Merck. I decided to go to McKinsey because the dirty little secret that they don't tell you until after you've already paid your tuition bills. They don't teach you a huge amount about business and how they operate at business school. And so I felt like, as somebody who spent all of my time in the social sector prior to business school, it would be helpful to have kind of a post-business school residency, if you will. And so I viewed McKinsey as that.
I'm sorry, that's because you went to Stanford. But
That's true.
No, I'm
Maybe
just
that's
kidding.
a completely fair point. So at Stanford, they didn't teach me much practical business stuff. And so I decided to spend a couple years at McKinsey. I don't know whether Dilbert is still a thing or not, but Dilbert, for those of you who appreciate fine cartoons, writes about the joys of the office life. And I basically kind of found myself on a study where I was living a Dilbert cartoon. And this was also at a point in time where our second daughter had just been born. My wife was still working full-time, and I was like, I need to take my kids to daycare in the morning. I go to work, and it's a Dilbert cartoon, and I asked for some flexibility from McKinsey, and the response was, you've got an afternoon nanny, hire a morning nanny. And so I looked around, and I didn't see anyone who I wanted to kind of grow up to become like. And trying to juggle 2-career family and spend time with kids, I said, I gotta get out of here. So that's what began my process for reconnecting with Jacqueline and rejoining Acumen Fund. I think that the other inflection point I would say is on leaving Acumen Fund, and I had a chat with Jack earlier today about, kind of any regrets. I've loved being at Bridges. I do think that had I left Acumen Fund and launched my own thing with the kind of confidence and conviction that I could just do it myself, it would have been super hard, but I think given what I know about others who have launched their own platforms in this space, I could have done that. The opportunity to join Bridges, felt at the time like being a small part of a bigger thing in a global firm made a huge amount of sense. But as I think back to that, the road not taken, it would have been really tough to have done, but I think, over time would have led to, slightly more independence and I think more rewarding professional challenge.
It's very interesting because my dissertation, as you know, was on first-time venture funds. And I would go out and talk to institutional investors, and they say, we never invest in first-time funds. And then I look at the growth rate in first-time funds, which was like 60% year over year. And it's like, well, some institutional investors are clearly investing in first-time funds, or they would never exist.
Yep.
My name is Clarissa. I'm a second year of full-time MBA here. So I guess my question was kind of really related to my neighbor's question about impact measurement, because you mentioned that right now, because there's no standardized kind of like a measure of assets versus liability, like how accounting does. But we all know that accounting, like in order to fulfill the accounting requirement, well, all the companies hire accountants and they have to pay for a price to do that.
Yeah.
But like when we're talking about impact measurement, if every like impact investing firms impose their own certain criterias or all those measurements, you kind of almost like adding a barrier to especially social enterprises or like, nonprofit that they have to adopt to first learn how to almost kind of like, do their book of answering the question about the measurement before they even do whatever work that they were doing. And we also know that in terms of impact, there's so many different areas. I mean, there are 17 SDG goals. And like, how do you make that trade-off in terms of each firms? How do they come up with their measurement? And how do they think about that cost burden? Not both imposed to, I guess, the investing company and as well as the company that got invested.
Hey, I just want to add to Clarissa's question too. One of my favorite articles I was sharing with you earlier is Simple Measures for Social Enterprises that you wrote, and talking about impact being baked into the DNA of the company, meaning you're not like a grant donor that makes somebody do a separate report that has nothing to do with their nascent business. So how do you walk that line? Like Corsa says, you have your 4-point scale. This is a social enterprise that is trying to just make the wheels turn, right? And then you've got to report the impact measurement.
A couple thoughts that are a little bit more kind of theoretical. I don't think until people are compensated for impact that impact will be taken seriously. And so if you think about the chain of capital from the asset owner who hires the asset advisor, who finds the fund manager who invests in the company, there is a set of guidelines around financial reporting which make sure that what's happening at the company go back up to the fund and are audited and go back up to the asset advisor to tell the asset owner this is what your portfolio has been doing. And fiduciary duty is a kind of principle which binds everybody at every link in that chain to make sure that what they're doing at the company level with that asset owner's money is in fact supposed to be generating the return for that asset owner whose capital it ultimately is. We don't have a comparable analog that I call impact fidelity, which is the asset owner says they want to invest in climate change. The asset advisor says, well, climate change is too narrow because you're going to have to trade off. So we'll do general impact. And then they invest in a jobs fund, which happens to be mining or creating fracking. And because it's an impact fund that cares about jobs, you find yourself at a fracking company when the asset owner has absolutely zero interest in that. And so there's no adherence to impact fidelity. And I think that a big risk over the next decade is that there will be some backlash between asset owners whose expectations are simply not met. The second thing is I think it would be a great thing if big companies, in terms of their impact on jobs and their environmental footprint, and right now they create these CSR reports. One of my favorites is to read the Volkswagen CSR report, the year before the emissions scandal. It's just complete bullshit. It's a waste of time and money, and yet they think it makes sense to put out, or the Wells Fargo community engagement report. Come on, that's complete horseshit. Pardon my French, but so we have this practice of writing stuff which is just either unaware or totally false. And so to have a discipline where people are supposed to understand whether Wells Fargo is truly investing in communities would be a good thing. And if you think about the number of accountants at Wells Fargo, maybe it's a solution to our jobs problem that we have thousands of people at big companies who are actually thinking about what are we doing in the communities where we operate? What is the impact that Amazon is having on employees and the communities where it is operating and the cardboard that it is consuming? So my starting point is not to belabor the small, struggling, Sanergy social enterprise in East Africa with all sorts of different reports. My job would be to start at big companies and say, what are you doing? What's the practice by which we think about and articulate employee benefits, community benefits, customer benefits, environmental benefits in a way that isn't this alphabet soup of ESG, SRI, PRI, GRI, but is a consistent and approachable measure? What's the QuickBook version for impact measurement that you train people on? Yeah, it would require, yes, it would maybe raise the cost of entry, that if you're going to be a social enterprise taking impact capital, you do need to think about this stuff seriously. But if we're not going to invest in impact, if people's financial returns are not linked to the delivery of verifiable objective impact measures, I think people are going to continue to write CSR reports that are greenwashing the underlying activities. And to me, that's the big challenge, is for us to figure out something that's robust enough but simple enough for people to use at scale. And sure, it will cost, but we at Bridges spend $50,000 to $75,000 on an audit, and our investors don't complain. That's just the cost of doing business. So what if we added a $50,000 to $75,000 impact analyst? And if we had an outsourced firm at Sunrise that spent $25,000 or $30,000 asking these questions of, well, do your customers actually survive better? Do they manage their disease better? Can we figure that out? And I think that is, in fact, a cost that we should be willing to bear, and that one that business has not really borne to date.
So on that note, I just want to do one final closing question. We sort of look at impact investing, and we've already touched on this, and people got very excited when JP Morgan did their original report of trillions of dollars of capital were going to be unlocked. And I know there's a lot of students here that, as you said, there's really high interest, because I think people do see a desire to, at least those seeking this profession, to want to do really good work and want to be fairly compensated, but also make a difference to make the world a better place. I do think that's an underlying theme that people authentically and genuinely embrace. And so where do we go from here to sort of bridge this gap of, presumably this capital happening? And we've had mutual friends in this area we've seen for years. I mean, John starting Imprint Capital, it's now being acquired by Goldman Sachs, and he says it's the amount of capital he can invest towards impact is much greater than he was when he was his separate company. How do we sort of start bridging this gap where we really get the capital and the connection and the jobs for this evolving industry?
Again, I think there are more opportunities than there are jobs, and I think that there are a lot of opportunities in established businesses and institutions that don't ask these questions. And I think if you leave Anderson and take a job with a big company or a small company and have that impact sensibility, you will be able to kind of start conversations within the company or within the nonprofit that many of these organizations just are not fluent in. And so, run hard at the impact piece, run hard at what you care about. And my guess is that there will be, in companies big and small, opportunities to create these links. I mean, who would have thought that, Goldman Sachs would have a large, asset management business focused on ESG even 10 years ago? And, that JP Morgan Chase or Morgan Stanley, all of these. So from my perspective, I think it is a long game. The number of opportunities purely in impact are relatively few, but the opportunity to apply this kind of thinking to any role that you take, to me, by definition, is infinite, because there is still a shortage of this kind of thinking. And I view that as the real opportunity, is to embed this into both existing businesses and new businesses that are starting every day, and haven't really given much thought to these questions.
Thank you. Thank you, Brian, for coming.
Thanks.